A shocking revelation about Australia's inflation rate has sparked an uncomfortable debate. Could interest rates be on the rise? In the past few weeks, we've seen a series of economic indicators that have left many scratching their heads. First, the unemployment rate took an unexpected jump, leading many to believe that the Reserve Bank of Australia, RBA, would cut interest rates soon. However, the latest news on underlying inflation, which excludes volatile price movements, has thrown a wrench into those expectations. The inflation conundrum. Underlying inflation, the RBA's preferred measure, climbed for the first time since 2022, leaving experts and homeowners alike in a state of uncertainty. Cherelle Murphy, the chief economist at EY, summed it up: a rate cut before Christmas seemed reasonable, but that's off the table now. This news is particularly unwelcome for homeowners, who are already grappling with a multitude of costs that have skyrocketed over the past 5 years. The prospect of rising interest rates adds another layer of financial strain. The experts weigh in. Johnathan McMenamin, head of economic forecasting at Barrenjoey, an investment bank, believes inflation will slow over the next year, and the RBA will maintain steady rates as they monitor price pressures. However, he cautions that if inflation remains hotter than expected in the December quarter, it could prompt the RBA to hike rates at the February meeting. Not many will be happy about that, McMenamin says, but the risk of a February hike is greater than a cut. This view is not shared by all. Richard Yetsenga, ANZ's chief economist, urges caution, stating, "Let's not panic. It's too early to say the easing cycle is over and the next move is a hike." The political angle. In Canberra, the Australian Bureau of Statistics figures landed with a thud. Jim Chalmers, normally quick to address the media after an inflation report, remained conspicuously silent. James Patterson, the shadow finance minister, raised the specter of stagflation, a scenario of high unemployment and high inflation reminiscent of the 1970s. However, economists dismissed these claims, with John Hawkins, a senior economics lecturer, stating that current unemployment and inflation rates do not indicate stagflation. The productivity puzzle. Yetsenga argues that Australia is facing the tangible reality of a less dynamic economy. Productivity is very tactile. The economy can't run as quickly as it used to without overheating and pushing inflation higher, he says. The RBA recently estimated that the potential growth rate is closer to 2% than the pre-pandemic rates of 3% or more. This reduced potential growth rate has implications for unemployment, suggesting that a rate consistent with low and stable inflation may be closer to 5% than the previously targeted 4%. A familiar story. McMenamin notes that post-COVID, the structure of the economy is beginning to resemble pre-pandemic times in many ways. We're slipping back to where we were before the pandemic, he observes. The debate continues, with experts actively discussing whether the RBA has finished cutting rates or if a hike is on the horizon. As the discussion unfolds, one thing is clear. The economic landscape is shifting, and the implications for homeowners and the broader economy are significant.